Investing is often seen as a game of numbers and logic, but what if I told you that your emotions and psychological biases might play a bigger role than you think? Today, we're diving into an intriguing topic: the role of behavioral finance in investment decisions. Behavioral finance combines psychology and economics to explain why investors don't always act rationally and how emotions like fear, greed, and overconfidence can affect financial decisions. In this video, we'll explore the core concepts of behavioral finance, common psychological biases that impact investors, real-world examples of how these biases play out, and strategies to make smarter investment decisions. By the end, you'll have a deeper understanding of your own behavior and how to use this knowledge to improve your investment outcomes. Let's get started. This is Wealthlocity. Here you create, protect, and grow your wealth fast. What is behavioral finance? Behavioral finance is a field of study that explores how psychological factors influence financial decisions. Unlike traditional finance, which assumes that investors are rational and always act in their best interest, behavioral finance acknowledges that emotions and cognitive biases often lead to irrational choices. For example, traditional finance might assume that investors sell underperforming stocks and reinvest in better opportunities. However, behavioral finance reveals that many investors hold on to losing stocks due to loss aversion, fearing the psychological pain of realizing a loss. Behavioral finance bridges the gap between theory and reality, helping us understand why people make decisions that seem illogical in hindsight. The foundations of behavioral finance. Behavioral finance is built on two key psychological concepts. 1. Heuristics. These are mental shortcuts we use to simplify complex decision-making processes. While heuristics can be helpful, they often lead to biases. 2. Biases. Cognitive and emotional biases distort our judgment and lead to irrational decisions. Understanding these concepts is the first step toward recognizing how they impact your investment choices. Common behavioral biases in investing. Let's explore some of the most common psychological biases that affect investors and how they play out in real life. 1. Loss aversion. Investors feel the pain of losses more acutely than the pleasure of equivalent gains. This often leads them to hold on to losing investments, hoping they'll rebound, instead of cutting their losses and reallocating to better opportunities. Think of holding a declining stock because selling it feels like admitting defeat. Reframe losses as learning opportunities and focus on long-term growth rather than short-term setbacks. 2. Overconfidence bias. Many investors overestimate their knowledge or abilities, leading to excessive trading or risky investments. It's like thinking you can outperform the market without thorough research or expertise. Base your decisions on data and diversify your portfolio to mitigate risk. 3. Herd mentality. Following the crowd often leads to buying at market peaks or selling during downturns, as investors fear missing out or being left behind. Imagine joining a stock rally late, only to suffer losses when the bubble bursts. Develop a disciplined investment strategy and stick to your plan, regardless of market trends. 4. Anchoring bias. Anchoring occurs when investors fixate on a specific piece of information, such as the price they initially paid for a stock, and let it influence their decisions disproportionately. Think of refusing to sell a stock until it returns to its original purchase price. Focus on the stock's future potential rather than its past performance. 5. Confirmation bias. Investors often seek out information that supports their existing beliefs while ignoring evidence that contradicts them, like only reading bullish analyses of a stock you own while ignoring bearish perspectives. Actively seek opposing viewpoints and evaluate all available information objectively. 6. Fear and greed. Fear causes investors to sell during market downturns, while greed leads to risky decisions during bull markets. Think of selling during the 2008 financial crisis, only to miss the recovery. Maintain a long-term perspective and avoid making impulsive decisions based on market sentiment. Real-world examples of behavioral finance. Behavioral finance isn't just theoretical, it plays out in real-world markets. Let's look at some historical examples. First, the dot-com bubble in the late 1990s. During the dot-com boom, herd mentality and overconfidence led investors to pour money into internet companies with little or no revenue. When the bubble burst, many lost significant wealth, so avoid chasing trends without evaluating fundamentals. Next, the 2008 financial crisis. Fear drove many investors to sell at the market's bottom, locking in losses and missing the subsequent recovery. Stick to your long-term strategy, even during market turbulence. Lastly, meme stock mania in 2021. Stocks like GameStop and AMC surged as retail investors, driven by social media and herd mentality, bought in en masse. While some made profits, others suffered heavy losses when prices corrected. Understand the risks of speculative investing and avoid chasing hype. The impact of behavioral finance on portfolio management. Behavioral biases don't just affect individual decisions, they can have a cumulative impact on your overall portfolio. Overtrading. Excessive buying and selling due to overconfidence or market noise can lead to higher fees and lower returns. Lack of diversification. Emotional attachment to certain stocks or sectors can result in an unbalanced portfolio. Inconsistent strategies. Switching strategies frequently due to short-term emotions undermines long-term growth. Recognizing these patterns can help you create a more disciplined and effective investment plan. Here are some actionable strategies to counteract behavioral biases and make better investment decisions. Develop a written investment plan. Outline your goals, risk tolerance, and asset allocation strategy. A written plan reduces the influence of emotions during market volatility. Automate your investments. Using tools like dollar-cost averaging ensures consistent investing, regardless of market conditions. Set rules for selling. Establish clear criteria for selling an asset, such as hitting a target price or changes in fundamentals, to avoid emotional decisions. Seek professional advice. Financial advisors or robo-advisors can provide objective guidance and help you stay on track. Take a long-term perspective. Focus on your long-term goals rather than reacting to short-term market fluctuations. Educating yourself about behavioral finance can transform how you approach investing. Self-awareness. Recognize your biases and how they influence your decisions. Critical thinking. Evaluate information objectively and avoid confirmation bias. Patience. Understand that building wealth takes time and discipline. The more you learn about behavioral finance, the more empowered you'll be to make informed and rational investment choices. And there you have it, a comprehensive look at the role of behavioral finance in investment decisions. By understanding the psychological factors that influence your choices, you can recognize biases, avoid common pitfalls, and make smarter financial decisions. Remember, successful investing isn't just about numbers. It's about managing your mindset. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who wants to improve their investment game. Let me know in the comments. Which behavioral bias do you struggle with the most, and how do you overcome it? Thanks for watching, and I'll see you in the next video with more money in your pocket.